Yeah, we got through September pretty well, Courtney. You're right. I think going into the rest of the year, I think one of the concerns is what happens around midterm elections. But regarding politics and trade in particular, we keep having our clients focus back on the strong economic growth. There was thoughts being that it was going to peak out in the first quarter, second quarter earnings and revenues exceeded. We think that's going to continue on into 2019 with no recession in sight until maybe late 19, early 20. Led by capital spending. So that kind of leads us to continued emphasis on the growth sectors. The consumer's in very good shape with job and burgeoning wage growth, so overweighting consumer discretionary. Technology, particularly the reconfiguration now, it's a lot of the core backbone technology names that should benefit from increased capital spending. And industrials in general, we think will do well. And then we do like financials now because we do think this yield curve will continue to shift upward and not invert until maybe late next year.
Ernesto, it seems like Ben believes what the Fed believes, that the economy is strong, the consumer is strong. They went ahead and hiked interest rates for the third time this year. Do you think they're going to hike again in December? And do you think they should? Is the market strong enough to withstand it? And is that what we need?
I think the Fed will hike in December. They have indicated that they're willing to go even beyond the neutral rate, so I don't see any reason why they would not do what they've said and hike in December. But more importantly, I think the economic growth in the United States, as my companion over here stated, the other guest, is very strong, and therefore you want to be exposed to that cyclical strength of the economy. And we favor value stocks, but that's where the cyclicals are concentrated to take advantage of that strong growth in the U.S. economy. The growthier part of the universe is more resilient to weaker economic growth, but the value part of the stock market is more geared or more leveraged to the economic growth, and that's why we favored it. And companies such as financials are very geared to that. For example, Citigroup, which trades at only 11 times and is benefiting from the rise in interest rates. Companies like that should do very well in this environment.
Ben, can we drill down on discretionary? It's a sort of a broad swath of companies dominated in terms of the sector by Amazon, but it's also got the retailers, which have done pretty well this year. It's got media stocks, which have not done well, and it's got home builders, which also have not done well. So where do you find the opportunity?
Well, one of the last ones you talked about, Melissa, it's been real disappointing, right, which was going on with housing. That hasn't recovered to the extent that it should, but it seems to be more of a supply than a demand issue. There seems to be enough pent-up demand, and so if we get to the point where you don't have a big spike up in interest rates, mortgage rates stay stable, consumers continue to do better with wage and income growth, we think that's an area that's probably the most undervalued that can move. And we do think with consumer spending being strong next year, the retailers will do well.